Hello, everybody, and a very warm welcome to another one of our Back to Basics episodes here at the Working Trader. Today, we're going to have a look at foreign exchange, also known as Forex or FX. I tend to use Forex, I think it rolls off the tongue a bit better. So, what is Forex? It's the exchange of one currency for another currency. It's used by big companies, particularly if they're operating in other countries, to hedge their currency risk. So, what I mean by this is that if you have a company and you're working in a country that has a different currency to yours, you could be doing fantastically, being very profitable. But if during the same time the currency, the foreign currency, is weakening versus your home currency, that's going to eat into your profits. So companies will have foreign exchange strategies to hedge that risk. Foreign exchange is used by large financial institutions and governments, so banks and central banks have foreign exchange reserves. And as you probably know, it's used by tourists. So when you go on holiday, generally speaking, you need to buy the local currency. You can't use your home currency. Now, of course, there are exceptions to this. In Europe, for example, a lot of the countries use the euro. They share that as their currency. And there are also some countries around the world where, although it's not technically the home currency, you can use US dollars. But these are exceptions to the rule. Generally speaking, around the world, if you want to buy something in another country, you have to first buy their currency, and that's foreign exchange. And you get the worst spread as a tourist. So we mentioned in a previous video, a spread is the difference between the price you can buy something for and the price you can sell something for, in this case, the currency. Um, so the big financial institutions and the governments who are dealing in large amounts of foreign exchange reserves, they have fairly tight spreads. But as an individual, as a tourist, you're going to have pretty wide spreads. And the very worst place you can buy foreign exchange, generally speaking, is at the airport. They're generally speaking a rip-off. They're great. They're convenient if you really desperately need it. If you forgot to get your foreign money before you left and you need to get a cab or pay for the hotel or something. But it's generally speaking better to plan your foreign exchange in advance, at least buy a bit for the sort of cabs and the hotels and stuff initially, and then when you're in the country, you can buy more of their currency. That's generally the best way of doing it. And foreign exchange is nowadays generally free floating. So there was a time in the past, decades and decades ago now, where all currencies were pegged to gold and then the US dollar. So it was fixed. The amount of dollars you could buy with your currency was always the same and it was fixed. It was pegged to it. Whereas now currencies are free floating. China's a modern day exception, which isn't a free floating currency per se. The government has a lot of control over it. Since this is just a back to basics video, we won't go into too much detail, but we'll have a look at it later, and it's definitely something you should look into if you're interested, because it is quite interesting. So if we're talking about trading foreign exchange, what are the risks and rewards of it? I think one of the biggest risks, and I guess rewards, if you do understand it, is that foreign exchange and the way the prices move are really hard to understand. They're heavily dependent on geopolitics and various economic policies around the world. They can be quite volatile intraday, and unlike when you're looking at equities, so stocks and shares, the ownership of a company, generally speaking, if you think you understand the company and the economy is doing all right, you can just buy, and if it's got good fundamentals and it's a profitable company, then you hopefully just buy it and the stock goes up. And of course, it's not that simple, but it's simple enough to get your head around. Whereas with foreign exchange, I think it's a lot harder to get your head around what's actually going on and what moves prices. So that's something to consider if you do want to trade foreign exchange. So what are some examples? So I've put here three of the most common currency pairs. There are obviously loads more, but you've got Euro US dollar Japanese yen, and US dollar Canadian dollar. So the currency on the left is called the base currency, and the currency on the right is called the quote currency. So if you think the value of the base currency is going to go up, you buy that pair. So you buy the pair with the currency you think is going to go up at the front. So in other words, you go long. And if you think it's going to go down, you short it. So you sell the pair. So as I've written there, in the case of the euro US dollar, if you think the euro is going to strengthen against the dollar, you buy this pair with the euro in front. And if you think the euro is going to get weaker against the dollar, you sell this pair. So hopefully this graph will explain a bit about why that actually is. So essentially what you're looking at with foreign exchange is how many of the quote, so that's the one on the right, do you need to buy the base? That's the one on the left. So this is a chart over the last year or so. And if you look, this Euro US dollar chart, by the way, for anyone who can't see the video. Back in sort of March, April time, when the economy and the financial markets in particular really started to crash, people thought US dollars were really safe, so they kind of ran into US dollars. So in the case of the euro US dollar pair, they were shorting this pair. So back in April, May, and the reason for this, by the way, is because the US dollar is generally considered a safe haven asset. It's something that people have a lot of trust in. So in times of distress, the dollar can tend to get stronger. So if we look here at the bottom in the sort of March, April time, you could buy €1 and you only needed sort of just over $1 to buy it, just over $1.05 to buy it. But now, I think because of the Fed's money printing and people's concern that the dollar is going to get weaker, this pair, the euro US dollar pair, has gone up a lot. So now, the amount of dollars you need to buy a euro is almost 1.2. So I think that's something that I took a while to actually understand what was going on, what the currency pair order actually meant. So I hope that cleared it up. And if you have any questions or you have any favorite currency pairs you like to trade, let us know in the comments below. And have a nice day. Thank you very much. Take care.